The primary risks faced by banks stem from activities related to their balance sheets. First, there is often a mismatch between the duration of which investors wish to borrow capital and savers' expectation to access their funds deposited with the banks at any time. To manage this maturity mismatch, banks maintain sufficient liquid assets to meet unexpected customer demands for cash. Additionally, a large customer base allows banks to pool and diversify risks, significantly reducing the likelihood of substantial deposit withdrawals. Second, banks are exposed to interest rate risk. In a rising interest rate environment, customers may look for higher yielding alternatives to banks' deposits. To retain these deposits, banks may need to increase the interest rates they offer to customers. However, since a considerable portion of bank loans have fixed interest rates, the bank's interest expenses on customer deposits may rise, while the interest income from loans remain largely unchanged, leading to a reduced net interest margin. Banks commonly use derivative instruments to hedge against this risk. Third, there is the risk of credit losses. If borrowers become unable to repay their loans, the lending bank incurs a loss. To mitigate this risk, banks conduct thorough reviews of borrowers' financial situations to assess their creditworthiness. Additionally, banks set aside credit loss reserves. Should credit losses occur, they are ultimately covered by the bank's equity capital.